the right way to look or invest into debt in a rising interest rate scenario is, first of all, you need to have a clarity on your cash flow. So if your cash flow is, let's say, 6 years clear to you, then you need to invest into a straightaway 6-year SDL, which gives you a decent return. Okay, 5-year SDL is giving 7.10, 7.05% return. So that return is locked in. Okay, so that is your what you call is IRR for the next 6 years. Okay, so and that is beating your current FD rate of whatever 5.45%. Okay, so if you are clear about your cash requirement, that you're not going to touch that or you don't need that in the next 5 years, that's the best way to go about it. That's the first answer. The second answer is, I mean, purely from a micro point of view. Earlier I have covered the macro point. Now I'm covering the micro point. The what you call is the credit spreads do not compress that much in times of rising interest rate scenario. And especially in India, because what has happened in the last 2 years, the yield curves for the AAA names have really compressed. I mean, they were sometimes going below GSEC yields also. Okay, but now, and for the last 2 years, the AA names and below and the sub AA name credits yields have still remained at 12%, 14. And that is a delta of around how much, let's say 600 bips or 500 bips, right? Now, if 500 bips carry protection is sufficient to take care of whatever MTM is going to come, especially if it is a short end paper. So if it is a paper of 1.5 years and you're getting at 14%, you're getting a carry protection of 500 bips. How much wrong can you go? Right?
And I think the retail individuals don't even have an option to sell it in the market because the liquidity is less. So it's more of a theoretical risk when we talk about retail individuals, the MTM one. So,
yes.
So as you rightly mentioned, is one should put money in these opportunities till the maturity. And
yes.
If they have ample cash, so they would be protected from the series of rate hikes. And since these are small tenor opportunities, so 1 to 2 years, it will not impact them much. Had it been a 10-year opportunity, it would have impacted them more.